April 20th, 2026, we got some headline news that made me raise an eyebrow. When the SEC and CFTC announce a joint amendment like this, the mainstream financial media and average advisors read the headline and cheer. They view it as standard deregulation, cutting red tape to make life easier for private funds. And they want you to share in their enthusiasm. Hi, I'm Kenneth Mraz, strategy specialist at Zang International. Let's look at what a private fund actually is and what this proposed amendment would allow them to hide. The traditional markets are heavily allocated into four main structures. First, we have private equity. These funds buy existing companies, load them up with massive amounts of debt to extract the cash, and try to sell them for a profit. Private equity is essentially a heavily leveraged corporate salvage yard. They acquire a functioning, financially healthy company, but to maximize the return for their investors, they immediately strap a massive boulder of commercial debt onto the company's back. As long as credit is cheap and the economy is floating right along, the company carries the boulder and everyone makes money. When a currency reset begins and liquidity freezes, the debt crushes the company. And with this new SEC rule change, the government just formally announced that they're no longer wanting to monitor how heavy those debt boulders are for any fund under $1 billion. They're seeking to engineer a regulatory blind spot, and they're giving private equity the administrative cover to hide their toxic debt payloads in the dark, right up until the underlying companies simply snap. Next, we have venture capital. They fund high-risk tech, biotech, and AI startups that burn through cash, that have not made, and possibly will never make a profit, hoping that just one becomes a multi-billion-dollar unicorn. Venture capital operates like a massive speculative greenhouse. They plant 100 highly volatile seeds, startups that don't actually generate real revenue, and they keep them alive by pumping in endless gallons of water, which is cheap investor fiat money. The math only works if the water never stops flowing. In a currency reset, during a liquidity freeze, the faucet shuts off overnight, and companies that don't generate real revenue instantly go insolvent. By raising the reporting threshold to $1 billion, the SEC would turn off the drought warning system for any registered advisor running these funds. They'd allow these venture capital funds to just quietly evaporate their remaining liquidity without ever having to report their collapsing asset values to the regulators until that faucet officially runs dry. Next, we have hedge funds. They use highly complex, volatile derivatives and massive margin, also known as borrowed money, to try and force a high return regardless of whether the market goes up or down. A mid-tier hedge fund is basically a highly pressurized nuclear reactor. To give you those massive annual returns, they don't just buy everyday stocks. They use these highly synthetic derivatives and margin to multiply their bets. As long as the cooling rods, known as investor money, are functioning, the reactor stays stable. But if the market freezes, the margin crashes, and the reactor suffers a total meltdown, like Chernobyl. Previously, Form PF was the temperature gauge that the government used to monitor the heat levels of those reactors. But now, the SEC isn't just proposing to tweak the dials a little bit. They're wanting to raise the reporting threshold for what they call a large hedge fund advisor from $1.5 billion all the way to $10 billion. That means any hedge fund operating with $9.99 billion or less in assets would no longer be subject to the enhanced quarterly reporting regime. In essence, they want to uninstall the temperature gauges on multi-billion-dollar reactors. When the margin calls hit in the coming currency reset, those funds would suffer a localized meltdown, and any retail or pension capital is trapped inside. Finally, we have fund of funds. This is an umbrella fund that doesn't invest in companies directly, but instead takes your money and scatters it across multiple other private equity, venture capital, or hedge funds. It's the equivalent of hiring a general contractor to build a house, only to realize he just handed your money to 20 different unknown subcontractors, all of whom kept a percentage of the cash. This means you don't even know where your money went. And this creates what we call counterparty risk. In plain terms, if just one of those unknown subcontractors goes bankrupt, he takes your money down with him, and it triggers a chain reaction that you couldn't even see coming. The government is wanting to make it so that your general contractor no longer has to provide a regulatory audit of his subcontractors under these new, much higher thresholds. You won't know the underlying funds are insolvent until your umbrella fund legally freezes your redemptions and halts your exit. Kind of just like Blue Owl, Morgan Stanley, and BlackRock recently did with their private credit funds. How did we get here in the first place? After 2008, the SEC Form PF reporting requirements was created to act as a seismic detection network for the financial system. They placed a sensor on every fault line, big or small, so they could detect the pressure building before another massive earthquake hit. This amendment is the regulatory equivalent of the government walking into the earthquake monitoring station, looking at the sensors, and deciding to unplug any of them on a fault line under $10 billion. The SEC tries to justify this in their proposal by stating that even with these massive blind spots, they're still going to collect information on over 80% of hedge fund gross assets. But as a strategist, I have to point out a fatal flaw in the math. Contagion doesn't require 80% of the market to fail. You don't need 80% of a forest to catch fire to burn the ecosystem down. You just need that one $9 billion spark to jump the fire line. Unplugging the sensors also doesn't stop the tectonic plates from shifting. It only guarantees that when the mid-tier credit market fractures, there will be zero federal warning. Do you get that? Zero warning. Which is why it's also important that you get a strategy in place sooner rather than later. Why would the SEC purposefully blind themselves up to $10 billion funds at this point in time? Do we really think they're doing this to just cut red tape? When you reach the end of a currency's life cycle, the foundation of the traditional credit market begins to break down. And the SEC knows this. If they force every fund to continue reporting their exact liquidity crunches and their unrealized losses on Form PF, that data enters the ecosystem, it creates a paper trail of insolvency, and in finance and economics, data creates panic. So by raising the reporting threshold to $10 billion right now, the SEC would be throwing a massive, opaque tarp over a large portion of the financial sector that puts your deposits at risk. They aren't fixing the cracks in the foundation, they're just making those cracks legally invisible to the public. If they silence the alarms so that these multi-billion-dollar defaults can happen quietly, so that you can't make educated choices and protect the wealth that you've managed to accumulate, that prevents a bank run. After 2008, if the SEC and the Financial Stability Oversight Council collect Form PF data showing that an $8 billion hedge fund is dangerously overleveraged and about to collapse, the Dodd-Frank Act dictates that they must respond to the emerging threat. If they have the data and they let that fund collapse, Congress will drag the SEC chairman into a hearing and demand to know why didn't they intervene to stop the contagion. But the government's balance sheet is entirely overextended. They can't remotely afford to bail out everyone at the end of a currency life cycle. So what's their only way out? They execute what I call plausible deniability. It's the equivalent of a security guard intentionally turning off the cameras right before a bank robbery. If he doesn't record the footage, he can't be blamed for not stopping the thief. If the SEC and CFTC legally vote to stop collecting the risk data on anything under $10 billion, then when those mid-tier and low-tier funds possibly freeze client withdrawals and collapse, regulators could truthfully stand before Congress and say, we had no data indicating that this was a systemic threat. And that is plausible deniability. The government is openly telegraphing that the only institutions they want to monitor, and therefore the only institutions that they intend to protect during the coming reset, are the trillion-dollar titans via bail-ins, capital incarceration, and wealth confiscation from you. How do you really feel about that? They're proposing that everyone else under a new $10 billion threshold should be designated as collateral damage. And that does include you and I. It's a natural human instinct to look at these massive numbers and think, I don't invest my money in a $9 billion hedge fund or venture capital. I just use a standard 401k and my personal bank account. That's institutional money at risk, not mine. As a strategist, this is where I have to point out one of the most dangerous illusions in the financial game. I call it the illusion of safe distance. A commercial bank isn't a parking garage that just holds your cash in a vault. It's a mandatory valet service. The moment you deposit your fiat money, the institution legally takes ownership of those funds, hands you a digital claim check, and immediately deploys that capital to chase their own higher yields. Where do you think they deploy that money? The traditional banking system funnels your retail deposits, your pension capital, and your retirement accounts directly into these exact mid-tier credit markets, derivatives, and umbrella funds. There's no magic shield separating your safe retirement account from their casino. When the SEC turns off the radar and a $9 billion fund suffers a catastrophic margin call in the dark, it isn't just institutional money that evaporates. It's the underlying collateral backing your own deposits and your own retirement account that's caught in the mix. As you look at where your capital is parked today, are you truly comfortable leaving it inside of a credit environment where the regulators are requesting to turn off the radar? At Zang International, our work is very simple. We look at the foundation of your wealth, we find exactly where the traditional system has left you exposed, and we help you move your money completely out of the blast radius of the fiat system. If you prefer to build a sound money strategy instead of just hoping things work out for the best, then you can scan the QR code on the screen, click the link in the description, or call us directly. Until next time, stay watchful.